Welcome to the BCA webinar. I'm Jason Mitchell. Super glad you're here. First of all, I want to apologize for a slight delay, technical difficulties. I want to say a quick thank you to the people behind the scenes on this that make this happen, Shane, Rhea, Zach, and Bryce. Like I said, I'm Jason Mitchell, and the guy next to me does not need any introduction. He's the man who puts BC in BCA. Brad, so excited to have this time to webinar today.
This. Yeah, I'm very excited to do this because it's an exciting time of year, especially for nonprofit clients.
Well, you know, when you brought this topic up, moves to make with your major donors at year end, I'm thinking, wow, is there enough time? But you're going to tell us there is time, right?
Yeah, there is time, yeah.
Okay.
It's important because donors now are starting to make their plans for the end of the year, and it's really important for major donor officers and gift officers to be in touch with their portfolio people or the people that they're talking to about the details that they need to make their final decisions.
All right, so before we get started, I just want to say a reminder that if you have questions, we're going to tackle those at the end. You can enter them in the chat to Q&A. That is an actual person who's going to receive those questions. We'll organize them for the end, so we'll make sure we save time for that. So Brad, let me set it up this way, if I may. So I'd like you to put us in the mindset of the donors. So what is going on in the life of most donors right now at this time of year?
Yeah, most of our major donors are making financial decisions at this time of year based on what they're receiving from their financial advisor, their tax advisor, and also their philanthropic advisor, whoever that is. So they're trying to make a decision before the deadlines occur because when December 31 rolls around, they have to have their decisions already made. So they're in that mode right now trying to make sure that all their plans are in place for the end of the year. And that's what they're doing right now. And that's why, of course, it's really crucial to remind them of some of the deadlines that they face.
And they're busy like us buying gifts and doing business stuff and all that other things that they're,
Correct. Life is moving on, and they're just trying to make sure it doesn't become too cumbersome to do something they need to do. So.
All right, well, let's dive in.
Yeah, the first thing I want to show everybody, though, is the important dates to remember. Some of these are self-explanatory, but please remember that a check must be postmarked by December 31st if they're using the United States Postal Service. And one thing that I've noticed over the years is that many gifts that are sent in at the end of the year by the post office are received in January. And so when they receipt those gifts, they end up with a January date on their receipt, and it's not right for the donor because the donor has a postmark on his. But what's happening now is lock boxes and other things are opening up those checks, and they're just processing them when they can, not when they come in. So you need to keep the paperwork, if you can, for the major donors in particular, and give them the date that they mailed that check, especially if they're trying to hit a December 31st deadline.
Because they're counting on it.
Yeah, and a lot of people hold on to their money until the last minute. It's got a lot easier now just to go online, and that's the next thing. If they're doing it by credit card, it has to be transacted by 11/59 on December 31st for them to count for this year. Again, this is only if they get audited, so just keep in mind that they just need the paperwork, but they want you to help them keep the paperwork. If cryptocurrency is being transacted, it must be received by December 31st. So that's a key point. Now in digital wallets, it doesn't happen immediately. There has to be some verification that goes on with cryptocurrency. So make sure that donors know that. Stock certificates must be postmarked by December 31st. But a money wire, this is interesting, a money wire has to be initiated by December 23rd. That's because of the bank schedule, because the bank's going to be closed.
Yeah.
And so they're not going to be able to do these things. So encourage your donors, if they're doing a money transfer or a money wire, that they start by December 23rd.
And we're going to lose some key dates this year with Christmas and New Year being on the weekend.
That's
right?
correct, yeah. So it's really important to remind them, just in a subtle way, that if they're going to do it if they're going to transfer money, that it needs to be done in that week before Christmas, really. Stocks and bonds, again, they need to initiate that by December 22nd. So December 23rd is a Friday. December 22nd is the Thursday. Again, now you're working with the banks, who's ever managing your assets. The custodian that's managing assets just need to be reminded that by December 22nd they need to get this started. Mutual funds, they're a little bit more difficult. They need to be received by December 30th. And then real estate, special securities, closely held stock, it has to initiate it as soon as possible. So if a donor has mentioned to you that they want to make a real estate gift to the organization, they need to start that as soon as possible so that they don't miss the deadline on that.
So question for you.
Yeah.
I'm sorry to interrupt. Other than a donor specifically saying, I want to make a real estate gift, what are some signals, if you will, that a major gift officer may pick up on either in conversation or even looking at the data that would suggest a donor may be ready to make a substantive year-end gift?
Yeah, usually donors reach out and they tell you, I have a special transaction that I'd like to do when I give my gift this year. So that has to be clarified. What is that special transaction? And make sure that you understand what they're trying to do so you can help them hit their deadlines on time. Because it's so frustrating if they're trying to give like a stock certificate of something along that lines, and then you don't know what to do. You have to go check with your stockbroker, and all this happens, and it delays it, and they miss the deadline, and they get frustrated with you, even though the intention was to do something very generous. So.
Check might go down the street next year.
That's right. Keep in mind, too, the QCD funds must come out of their account by December 31st. So those are some important dates. And if you have questions about that, by all means, just shoot us a question, and we'll try to answer that by the end of this webinar. There's some key moves to make with your donors before year end. I recommend to all the major donor or major gift officers that we work with to reach out and communicate to your donors. So you should know them on a first name basis. They should be willing to take your communication, either a phone call, a letter, or an email even, just to remind them and send them some subtle reminders of the deadlines that they need to hit to get these qualified gifts in. Use assumptive language as always, and by that I mean when you're talking to your donor, just assume, especially if they have a pattern of giving to you every year at year end, that that's what they're going to do again this year. If they clarify that they're not going to give you a gift, they will tell you so right away. Again, because you have a trusted relationship with most of these people that you're talking to, and they do want to talk to you about these details. So by all means, start reaching out to them as soon as you can. Do some research too, if you can. If you have some demographic information on your data, look at that demographic information, because people who are 70 and a half and older, 71 and older, they have special deadlines they have to hit as well. Know who those people are, communicate to them specifically. If people in the past have given to you every other year, they may be bunching, and so you might want to talk to them about what they're doing, and we'll explain what bunching is in a second. If people are giving to you the same amount every year, you may, again, just call them and thank them for their gift. Using assumptive language that you anticipate that they're going to do it again this year, let them qualify that they're going to do it again this year, and also how they're going to do it. Those are the things you want to do. But do some research on all your donors before you reach out to them.
That's great.
Let's talk about two of the vehicles that are really important for older donors in particular. That's the RMD and the QCD. So if you're a gift officer working for a nonprofit organization, you probably are aware of the required minimum distribution. So the IRS mandates that money that's sitting in a 401k or a 403b or a traditional IRA cannot sit there forever. And the reason for that is because it hasn't been taxed.
They want their money.
They want to make sure that they get their tax. So at 70, well actually this year it's 72. At 72, there's a requirement that you draw down 27% of your assets. And then that, since it's not being taxed, it's a prime place for donors to give money away if they want to, because then they avoid all the taxes that go along with it. So again, keep in mind, this is very specific by age. If you have demographic information on your donors, it should be very helpful. But at age 72, this mandate continues on for the rest of their life. And basically what happens is every year it draws down a little bit less, because the 27 is based on lifespan. In other words, they think it's going to take you 27 years to live the rest of your life. Therefore, you need to start drawing down this number. So the first year that a person is required to do a minimum distribution, they must declare it by April 1st. But from that point forward, it's December 31st. They have to make sure that the money is transacted and it's out of their account.
So that's interesting. So let me ask you this. If I'm a major gift officer, this seems like it could be a really interesting targeted strategy for a prospect pool, maybe looking at 70 and up or 72 and up. as potential candidates who may fall into this category as a means to reaching out and targeting a group of donors at year end. Would that make sense?
Yes, absolutely. In other words, everybody now that is at this age is dealing with this. So if you have information of a person who has capacity, hasn't made a major gift yet, they may not know about it, and they may want to know about the fact that they can avoid some of their taxes by giving money that's coming from their tax-exempt funds, if that makes sense.
Yeah.
So that's why you want to do that.
So I want to clarify two things real quick. Because he's had to explain this to me multiple times, we will make these slides available for you. So they're really good details here. But also, I can't remember the second one, so I'll just pitch it back to you. I know that
QCD?
Yeah, that's the next one. The vehicle.
So again, this is the chart. You'll have. I'll make sure that everybody gets this chart that wants it. This is the chart for how much it has to be drawn down by your life expectancy, and it's kind of uniform, so you can find these charts everywhere. But this is giving you an idea of what's going to be drawn down. The QCD now is the opposite. It is a qualified charitable distribution. So in this particular case, rather than drawing the money down, you just contact your fund custodian and indicate to them that you want this money transferred over to the nonprofit, and then it will count as your RMD.
I got you.
So that'll be your required minimum distribution. You can work with both your financial advisor, your tax advisor, and your custodian to make sure it's the right amount at the right time. Again, keep in mind, it has to be transferred by December 31st for it to count for a tax deduction on their next year's filings. And there is a limit. The limit is $100,000. So again, not everybody's going to have that kind of issue where they're going to give you $100,000 from their QCD. It's actually could be $200,000 for a couple. So everybody can draw up that much, but they can't do more than that in their qualified charitable distribution. And if you need some questions about that, by all means, again, shoot us questions in this webinar, but we'll be glad to talk to you about that later as well.
So in layman's terms, I'm 72 plus. I'm required to take some percentage out of my 401k. I can choose to spend it on myself, give it to my kids, or if I don't want the implications of taxes, I can consider the vehicle, which is the QCD, to deliver to a nonprofit.
That's correct.
Okay.
Yeah, because you get the full tax benefit and you avoid the taxes on that money. You know, it's interesting, when I was doing my estate planning with my wife, our attorney recommended to us that we give that money away first, because we have a significant amount that we've decided to give to charity in the future. And my wife said to me, well, I worked hard for that money. And I explained to her, you did work hard for that money, but you haven't paid taxes on any of it. So it's nice to give it and get both the benefit of the value of the contribution and avoid the taxes that come along with it. So
great.
The next thing we want to talk about, though, is the donated securities. So donated securities is probably the most common way a major donor is going to make a contribution, because it just makes so much sense. But I want to talk about donated securities in two ways, both the appreciated assets and the depreciated assets, and I'll get to that in just a second. But donated or appreciated assets are the nicest ones, or the easiest ones to deal with. One of the most effective strategies for giving at year end is always to donate these appreciated assets. So if you held stock for over a year, now keep that in mind too, the stock has to be held for over a year, you can donate it and then avoid your capital gains on that stock. Let's say you've had the stock for 5 years or 10 years and it's grown substantially. Maybe in this last year it hasn't grown that much, but in the past 5 years it grew substantially. And then you want to make a donation. Well, it's great location to make that donation because you avoid capital gains. You get the maximum amount of that contribution applied to the charity that you're giving to.
So I'm assuming that's interesting, because then they can essentially give away of something maybe they don't need or expect in terms of that growth as a substantive gift.
Yeah. And the nice part is, capital gains taxes are 15 to 20%. So it's pretty substantial in there. And then the application of that credit actually goes to future capital gains. So it's a win-win in that regard, that the donors are getting something they can use in the future as well. So again, keep in mind, donors will be able to deduct the appreciated value of their securities as well as avoid these capital gain taxes, and it's a double benefit for both. Now, there's another interesting thing called tax loss harvesting. Not a lot of people understand this, but it's really possible for a donor to benefit from depreciated stock. So what happens in that case, if they want to unload stock, and again, they've had to hold it for at least a year, they can sell it first, take the money, take the loss, and then donate the money to their charity. Then they get a win-win in that case because their capital losses can be used to offset future capital gains, and the donor can claim a charitable deduction on the donated cash. So again, not a lot of people talk about this, but the tax loss harvesting is a key tool in strategic philanthropy. People know how to use this. Most of the tax advisors will tell you how to do it. And it's not that hard, but they have to get started on that right away if they're going to do it that way.
So it's interesting because talking about the stock market with the donor isn't just small talk then, is it?
No.
Because depending on whether he or she is optimistic about the market going forward or pessimistic, you can potentially reroute the conversation in a certain manner. They may want to take losses now as opposed to seeing further losses in the future if they view the market going that direction.
Exactly, and I know this because in meeting with donors recently, they're talking about assets. They're talking about the value of their portfolios because everybody gets a quarterly report or multiple quarterly reports, and they're reading them and saying, "Oh, man, my portfolio value has gone down." Now they may have some stocks in that portfolio they want to get rid of. Well, it might be a good time to talk to them if they're interested in tax loss harvesting to do that now. But again, they should get started as soon as they can so that they can make sure all these things take place because they do have to sell that stock first, take the cash, take the loss, and then make sure it's recorded properly.
Mm-hmm. That's great.
Good. The other interesting technique that donors have been using is bunching. And this is something that I find real interesting because what's happened is the IRS has come back and raised the standard deduction. So when the standard deduction is raised, it's a little over $12,000 individually, $25,000 total for the family. People say, well, I'll just take the standard deduction. I don't have to itemize. However, if you bunch things, and this is what some people may be doing in your system right now, they may be itemizing one year and taking the standard deduction the next. The reason for that is because their tax advisor is saying this is the way to maximize your giving. So in some cases, donors will then reach out to you and say, I do want to bunch these together for this year. By that I mean, let's say they typically give you $5,000 a year, well, they may say to you, I want to give you $10,000 for this year and next year. So what you have to do as you're accounting for this is make sure that you know that this is a gift that's coming for a 2-year payment. It's like a pledge in that regard. But it's a technique that is used by tax advisors now to take advantage of both the standard deduction and the itemized deduction.
So if you were to try to identify, again, target a group of people like this in the database, would someone who's a candidate giving in December or giving every other year in December sort of be a candidate for this, right?
Absolutely.
As potentially the conversation.
Yeah, if you see that in the data, that their pattern is every other year, then it's worth a conversation to help them to help understand, is this the technique that they're doing based on their tax advisor's recommendations? So, and most donors will talk to you about that because they think it's really a great strategy in that regard. But if that's what they're doing, try to clarify that.
Or you could bring that information to them and they could benefit from itemized deduction in a particular year and benefit
correct.
over a 2-year period of time. That's great.
Yeah, some people may not even know that they can do it that way. And quite a few financial planners and tax advisors are recommending that nowadays because of the increase in the standard deduction.
Sure.
Yeah. I also want to talk about state deductions. Now, not all of you on this webinar will benefit from state deductions because you don't have them. If you live in Texas, for example, we don't have an income tax, we don't have deductions. But quite a few of you on this webinar will have some of those. Like, for example, I've noticed that Kansas and Iowa and Missouri and other places that I know some of you are at right now, they do have a state charitable tax benefit. And this chart will show you what it is if you haven't, if you don't already know that, you probably already do. But just a reminder to your donors that our state does give a benefit for a contribution, and the list is there. And again, we will make this available to everybody who wants it.
substantive in some states too.
Yeah, it can be. It can be very high, but usually it's highest most in states that have the highest income tax.
Both and.
Right, unfortunately. So again, take a look at that list. When I was out of state this year, I was talking to some donors. They were very aware of their contribution based on the state benefit. And so again, strategic philanthropy is done in a way that they're talking to their financial planner, they're talking to their tax advisor, and they're making their decision based on those things. And they're structuring their gift that way. So keep in mind, if you're watching the details carefully in the database, you can tell what is happening because of that. One of the other things I'm going to talk a little bit of time about is a topic that's interesting, is really interesting to me because of how much it's grown, and that's the Donor Advised Fund. So most of the gift officers that we work with don't like dealing with donor advised funds because they come in an anonymous form oftentimes. They'd rather the money come right to the charity rather than go into these accounts. But the reality is they're here and they're here to stay. Now they may change in the future about some of the rules around them, but right now the donors are really, really liking this tool. And on your screen you should see what just came out of the most recent report from the National Philanthropic Trust. There are over 1 million donor advised fund accounts. Now those accounts largely rest in a national charity, and it's called a national charity, but really it's a financial manager or a wealth manager. So the largest one is Fidelity. Fidelity, the big wealth manager firm, has a huge donor advised fund program. Schwab, Charles Schwab, Vanguard, those are the three biggest. They hold assets that are staggering. In fact, the next slide is going to show you that there's $159 billion in these donor advised funds right now. I want you to think about that, $159 billion.
It's a lot of money.
Yeah. 145 billion is sitting in those national charities.
Yeah.
It's sitting in this wealth management firm. So what's happening is wealthy individuals are putting money into their accounts, and then their advisors are saying, hey, if you need to make a contribution before year end, just put it into your donor advised fund. It'll count. And it does. It works that way. Now, a lot of nonprofits, as I mentioned, they don't like that. They like talking to donors.
They want the cash gift.
Yeah, they want the cash. We need it now. We need to hit our goals. We need to do this. We need to,
Sure.
It doesn't help us if you just put it in your other bank account. But it's a tool that the donors like to use, and they are using them.
Can you give an example of a scenario where a donor would be not willing to potentially make a gift to a charity and choose to do a DAF instead, even though they care about that particular nonprofit? Like, what would be a scenario that they would choose to do that?
Yeah, and we're encountering them more and more. So what's happened is, rather than go through all the steps, their tax advisor and their wealth manager will just say, you need to give away $30,000, $40,000 this year. But rather than worry about how you're going to do that, just put in your donor advised fund and make that decision down the road. So in a sense, it just delays the inevitable that you're going to give it away. Now,
Super easy.
Right, exactly.
Yeah.
It makes it really convenient for them. Now, the rules are, though, if it goes into the donor advised fund, it's a gift. It cannot be spent. It cannot be used any other way. It has to be distributed. And the argument has been, well, no, people are just sitting on their money. They're not really distributing this money. So I don't want to encourage my donors to develop this strategy, when I think you should be doing that. You should be encouraging them to use their donor advised funds properly. Because if the money is going in, it is coming out the next year and following. And they're probably giving it to the people they enjoy working with the most.
Sure,
Yeah.
sure. So that number's only going up every year. And
Yes.
if you have a good relationship, theoretically, your potential to receive a gift goes up as well.
Yeah, the next slide is going to show you that in 2020, 47 billion out of that 150 or so billion came out of these donor advised funds. So a
More
third
than
of
you
it.
think. Yeah, it's a third.
Yeah, so it's coming out. It's not probably at the rate. I mean, most nonprofits would say, I'd rather have the 150 billion.
Of course.
Well, sure.
Who wouldn't?
But it is coming out. It's coming out the way it's intended to. In the future, the government's probably going to step in. It looks like at this point, they're going to step in and say, no, you have some requirements. You're going to have to give away a certain percentage, or you have to get rid of it in a certain time period. Just like the foundations are required by law to give away 5% of their assets every year, the donor advised funds are probably going to encounter that in the future. But right now, you don't. You could put it in there and just leave it there for as long as you want.
So here's maybe a dumb question, but what would happen, say a donor passes away and then it goes into trust? Those are already receipted philanthropic gifts, so then...
It has to be given away,
Yeah.
but it can. It can go into an estate and stay there. In other words, there have to be rules around it, but the rules are such that
Distribution becomes someone else's decision.
could be the kids' decisions in the future, yeah. So that's what you have to pay attention to in that regard is what are their estate plans? And again, this is another key indicator for major gift officers. If a person has a donor advised fund, they are making plans for charity in the future, and they are your plan giving prospects. Now, one other thing that is a little bit confusing is when you get the check, it comes in the form of a check literally from Fidelity. So typically when you enter that into your database, it's going to be hard-coded to Fidelity. And then if they told you who it came from, it'll be soft-coded to that donor. Oftentimes, they don't tell you who it comes from, but many times they do. Now, you have to pay attention because the check will say Fidelity, and then in the memo, it'll say from the Johnson Family Fund. Well, then you might want to clarify with the Johnsons, is this a gift from you? Because what they're saying at the National Philanthropic Trust is the majority of people do want you to know that they're giving money out of their donor advised
It becomes a stewardship issue, too.
It does, yeah. And then it's our job as gift officers or people on the nonprofit organization side to make sure it's coded properly and marked. And the easiest way is to mark in your database that donor is a donor advised fund contributor. And so therefore you'll know it in the future when gifts come in at a certain amount from a certain season, that you might want to clarify with them, is this from your account? Now, a donor that wants to be anonymous, truly anonymous, they will be able to do that. And you have to respect that, of course. And there's all kinds of reasons why donors want to be anonymous. But just keep that in mind, too, that if a company like Fidelity, Schwab, or Vanguard wants to maintain the anonymity of that donor, they have every opportunity to do so. And again, we can answer more questions on donor advised funds. If you have them, just submit them to the question and answer section of this webinar. The other thing we have to talk about, though, is inflation. Now, inflation is, it's a bad word for many of us.
Kicking us all.
All of us, I know. But it's affecting everybody. In other words, the price of gas is not a good example because it's starting to come down finally. But a lot of our clients know that food prices are they're escalating significantly.
And diesel's still high, so anybody who's transporting goods around still paying a pretty penny for that, too.
Yeah, diesel, home oil to heat your house, all kinds of things are escalating in price right now, and it's affecting people now because salaries aren't able to keep up with that, and that's, of course, the definition of inflation. Now, it's an interesting world because, of course, typically one of the outcomes of inflation is a job market that is in bad shape, and our job market is just the opposite.
Yeah.
So it's deceptive. People don't know exactly what's happening at all levels. But it's affecting your donors just like it's affecting you and I. Everybody's affected by...
In general, would you say inflationary times cause donors to be a little bit more conservative with their philanthropic decisions?
It does, especially for those that are living on fixed assets. They get a little bit concerned because their cost of living is going up and they have a set amount coming in every month. And so the older person in particular may be especially concerned about that. But the entrepreneur, they tend to be generous and understand now's a good time to talk about a donation with the entrepreneur, the person who's working, has an active income, and can do something to affect all kinds of positive outcomes. For example, I always recommend if you're a gift officer right now and you have a donor that has been giving to a program year after year after year, you might want to talk to them about making an unrestricted gift this year. And the reason for that is because now your organization is paying more for diesel, your organization is paying more for food, your organization is paying more for utilities, all across the board, and that way it'll help you pay those bills. So that's something you may want to consider asking a donor to consider at this time of year. Also be prepared when you're talking to your donor about this tax loss harvesting strategy to see if they might be interested in that, because that is something that I think that a lot of people would be very interested in learning, that they can, I don't want to say dump stock, but if they have a stock they don't like anymore, they can say, well, now's the time.
Yeah.
Now's the time to do it. And it can provide a lot of help if I do it the proper way. So just keep in mind that it is affecting a lot of people. I want to show you an example that I thought was real interesting. Now, I prepared this last week, and again, forgive me, because the stock market today, if you go to the stock market right now, it's probably at 30, or the Dow Jones Industrial is probably at 33. But when I compared the Dow Jones Industrial to 1 year previously on November 30th, it was about the same amount. So I know we've been through this roller coaster this last year. The Dow Jones was at 34.5, December 3rd, 21. And November 30th, it was at 34.5 again. So even though that roller coaster has gone up and down, up and down, up and down, as you can see in that chart, it's at the same amount. Now I want to show you what it looks like over a 5-year period, though. So the next slide is over a 5-year period. And the stock market has grown 42% over that time period. So again, donors will talk to you about their assets being less valuable than they were a year ago. In reality, they're probably very similar, even though today the stock market is going through a little bit of a decline. But in general, they've, over a 5-year period, if they've held their stock that long, they've really seen some substantial growth. And then, of course, that huge dip in June of 2020, when the pandemic hit and everything tanked, it's been all the way up until just recently it started to come down.
Yeah.
So if you are in that role of a philanthropic advisor for your donors, please pay attention to what's going on in their assets, because that's very, very important as well. The things I want to remind everybody on, and again, we have times for question and answers after this, but I do want to just give everybody some subtle reminders here. Donors give to you primarily because they believe in your mission. They don't give for tax reasons. It is a secondary benefit, and it's strategic, so they want to take advantage of it, but they give because they believe in what you're doing, and they're with you. So keep that in mind, please. Strategic philanthropy is beneficial for both your organization as well as your donors. So learn some of these tools that they're using. Don't be afraid to talk to them about it. Because they want to talk about it. My experience is they want us to mention to you how you can help them take advantage of some of these tools that exist. And that brings me to my point, be willing to be a philanthropic advisor to your donors. Now this is interesting, because I don't know if many of the major gift officers that I've met with, talked to, feel comfortable being in that role. But I think your donors are looking for you to be in that role. You are their philanthropic advisors. What should I do with the assets that I have? And the questions have to come. You have to ask, what do you care about? What do you want to do with your assets? What do you want to do with your life? What values do you want to pass on to your children? All these things are important. And now's a good time, if you have those conversations, to engage your donors in those conversations, because they do want to talk to people about this. And there's not many philanthropic advisors around. There's tax advisors, there's wealth managers. There's not many people who can say, this is how you can make the biggest impact in charity. And in some cases, be mindful that they may not point to your organization as the primary charity they care about. Now I had this story happen to me when I was in Florida. I was working on a capital campaign, and I was approaching this donor about a gift to our capital campaign. And the woman was heartbroken. She had just lost her husband. And he died of a massive heart attack at a very young age, and she was shocked. She was shocked, the family was devastated, and she wanted to make a gift in his honor. But I said to him, you know what, you need to really consider making a gift to one of the causes, the American Heart Association or somebody else that is passionate about what you're going through right now. So I called up my friend who worked at the American Heart Association and said, why don't you call her and talk to her And he said, I'll do that. And she made a gift to them. Now, fast forward then another 20 years. Well, when it came time for a planned gift, the organization I worked for got the planned gift. They didn't get the other organization, American Heart, didn't get the planned gift. And the reason for that was because of the way that relationship developed over the years. We became a philanthropic advisor to her, and she then trusted what we had to say, and then she gave a very generous gift in her estate planning process. All that to say is look for the best interest of your donor always. Always, always, always look for the best interest of your donor, and they will love you for it. So just keep that in mind.
That's such a strong point, because I feel like the advisors that most people had that you mentioned, financial, accounting, legal, are going to provide recommendations that are going to be beneficial to them. And in a way, that's exactly what you did to that donor. What would be most meaningful and beneficial to her and her family at that time, and it came back around at some point too, because your organization or your former organization was also important.
Yeah. And then again, to their credit, they spent they really worked hard to develop the relationship. And again, this is a good gift officer when you realize it's relationship, it's not transactions. Just focus on who they are, understand what they want to do. Give a good listening ear to what's going on in their life.
That's great.
And then lastly, I want to be a reminder to be mindful to fulfill your stewardship obligations to your donors. Thank your donors. Always, please thank donors. Donors don't get thanked enough, and they tell you from time to time, oh, you need to thank me. But the reality is we all do. So thank your donors. Don't listen to that. I know that they will constantly tell you that. Don't worry about it. Now, they may say, don't send me a receipt. That's different. But make sure that they know how much you appreciate their contribution to this cause, so that they keep you in mind in the future that these are people who appreciate what's going on here. And then if they've asked you for something, fulfill it. One of my big frustrations over the years, and I shouldn't bring this up at the very end of our webinar, but
end on a frustration.
You say, hey, I'm going to make this contribution, but I would like this in return. I'd like a report, for example.
Yeah.
Well, that person then leaves that organization. It's not entered into the database.
Never stewarded.
No one's ever fulfilling what I've asked them to do. And they're like, what are you so frustrated with us for? I said, well, it's because I asked you to do something simple.
Yeah.
It wasn't done. And now a new person is in place, and they forgot totally what the other person promised. Well, just enter that information into the database so it doesn't go away, and that the organization can fulfill those stewardship obligations in the future.
It's a good, strong point about stewardship, not just being a conversation, but it's part of the infrastructure.
Absolutely. It's part of building a relationship, a lifelong relationship with people. So, well, thank you. That's the bulk of this presentation. I want to...
You ready for some hard-hitting questions?
I don't know if we have questions, but we'll see.
Yeah, let's see what we got. Let me do this one first. So with the decreasing value of crypto, should we be expecting or encouraging people to give via cryptocurrency?
I would.
Okay.
I would, yeah, because I think crypto is, people have experienced a very cautious tale with crypto. Crypto's not easy for many nonprofits because they have to go through somebody who can process it. And if you are in that case, you might need to contact your local community foundation, because they do have the ability, most of them have the ability to process cryptocurrency. But again, it's the strategy of the tax loss harvesting that you want to talk to them about, because they probably have lost quite a bit of value in there. However, they may have held it for a long time. Like I have, I've got some crypto that I've held for a long time.
It's still up overall.
Yes, it's still up. Yeah, and so there's still capital gains, even though it's not very much. But the point is that some people have crypto they've had for a long time.
Okay, here's a real practical one. Anything that we should do to be prepared to receive large gifts online, with our payment processor, et cetera, things like that? What are some things that you've experienced or seen in terms of preparation is necessary?
Yeah, I have a real funny story that happened. I got a call December 31st. This is years ago now. The food bank called me, and a local food bank called me and said, hey, a donor's frustrated with us because he's trying to give a $50,000 gift online, and it won't accept it. Yeah. And I said, well, tell him to make two $25,000 gifts. And it worked. It worked.
Sure.
But he was frustrated, and they were frustrated. They were like, why is that? I said, well, because gift processing has limits. And so know what your limits are. So if your donor...
And make a plan.
Yes. If they're going to go online and give you a substantial gift, you better make sure you know that they can do so. Otherwise, they're going to get frustrated. I mean, this has just happened to me last week. I was trying to buy tickets to a football game, and there's all kinds of restrictions and double verifications going on, and it's real frustrating to me, so I just stopped the process and went to another route to buy the tickets. So these are things that are happening now, especially the double verification. So make sure if your gift processing has adopted double verification, in other words, what they do is a donor is going to enter a gift online, and then they're going to say to them, give us your phone number because we want to send you a text to verify it's you. Well, if that process goes on, you may lose the donation if it's complicated. So check with your gift processing or your credit card processing to make sure that you know the security measures that are in place for large gifts in particular. Very smart thing to do at year end.
Awesome. Well, it looks like it's it. Anything else that you want to say to put a stamp on this?
No, just glad that you guys could be a part of this, and go get them, man. It's
it's a good time.
It is a good time, and it's been difficult for many nonprofits because of the that they saw the huge increase in 2020 and 2021, and they're just experiencing a little bit of a downturn in 2022. However, we're seeing the same thing: fewer gifts, but larger gifts. So people that are coming to you are giving these larger gifts, and they want to make a big contribution or a big difference in the world through your organization. So just be in mind that major gift officers at this time of year are especially important to the organization. And then please let us know if you have any questions.
Yeah, thank you again. We will be following up with an email as we usually do, so you'll be able to have a copy of this presentation if you should like, and also a link to the version of this video webinar, which will also be available on our website under the resources tab. Excited to announce next month, Senior Vice President Lauren Toon and Account Manager Jana Jefferson will be doing a next month's webinar, Strength, Dignity, and the Power of Story. Storytelling is super important in fundraising, so we're going to learn all about it next month. I hope you'll join us. Have a great day. Happy Holy Days.